All right, we're going to talk a bit about other people's money. And what I mean by that is when you're coming in, you're going to buy a house. This is going to be more for the first time home buyers. It could be for somebody that's selling and moving up and they just didn't make as much as they thought on the other house. But other people's money, where to get money and be able to continue in the process of buying a home. One of the places you can go is what they call lender credit. Lender credit is when the lender is giving you money towards your closing costs. It can't be towards down payment, but it can be towards closing costs. So why is a lender going to give you money? Okay, you come in, you qualify for a 5% loan, but you need money towards your closing costs because you have enough for down payment, but you're having a hard time coming up with the closing costs. So you want money towards that. Instead of taking a 5% loan, a lender can give you a loan for say 5 1/4 or 5 3/8. And with that, they might be able to give you a $2,000 credit. That would be used to pay $2,000 of your closing costs. So one way to do it, lender credit, instead of taking the rate that you can get for free, you're going to take a different rate, and that's going to cost you in the sense that you're going from, for an example, 5 to 5 1/4. But the advantage is you're going to get a seller credit. A lender credit gives you money back. Now we're going to seller credit. Seller credit would be you're buying a seller's house and you're asking them, I'm going to give you the $250,000 you want for it, but I need $5,000 towards my closing costs. And the seller can say yes or no. And again, the seller credit cannot be used for down payment. It can be used towards the closing costs. On that, with the seller credit, sometimes you'll look and you'll go, okay, the house for sale at $250,000. But when I look at all the comps on the sales, I think the house will sell for $255,000, $258,000. So you do what they call stack the offer. You're going to offer the seller more than what they're asking for on the house, and then in return you're going to ask for money back towards your closing costs. So that's another way to do it, seller credit, other people's money. The next one is gift funds. Gift funds are available through most any program, and they have to be received as gifts. They're not a loan. They have to be received from a fiance or a spouse or a parent or a grandparent, somebody that's family. The one exception to that is some programs allow employers to give you a gift fund. Pretty easy. The gifter is going to be sending money in on your behalf towards this purchase. These can be used towards down payment or closing costs, and they're going to sign a letter saying, hey, I'm giving this to them to use towards the purchase of their house. There's no expectation of them to pay it back. And pretty simple like that. So gift funds, that's another way to get it down with other people's money. The last one is down payment assistance programs. I've talked about this on another module, so find that module and go through. I won't bore you with it again here. But down payment assistance programs are another great way to be able to get into a house sooner rather than later. All right, there you go. Using other people's money. Hey, if it makes it work, why not? We'll see you in the next module.